All right, my friends, you need your dividends reinvested. I'm going to show you the proof of that right here in this beautiful masterpiece by your old buddy Josh, the Vermeer of Milton, Georgia, right here. Vermeer is who has the picture of the girl with the pearl earring, I think. Yeah, we have a print of that upstairs in our dining room. It's a wonderful picture. It's actually a book on it. It was wonderful too. I think even a movie. Anyway, so this right here is my masterpiece of looking at dividends reinvested versus dividends not reinvested, and the significant benefit of the dividends. The proof is in the pudding why you need your dividends and why you need them to be reinvested. So, subscribe. However you're getting this content, be it on YouTube or Facebook, I'll probably upload this to a podcast as well. Subscribe, thumbs up, comments, questions, concerns, the whole thing. Help me down in the comments there. So let's dive right into this. The premise of this whole beautiful Vermeer for old Josh is that I was looking at fixed index annuities, and every single one that I saw, every single one, they had a price to price or point to point cap. And what that simply means is you're not getting your dividends. So be it index universal life, indexed annuities, structured products, index structured products where you're point to point, price to price, you're not getting dividends. And if you're leaving dividends on the table, you're leaving money. All there is to it. So we don't want you to do that. I'm not saying don't buy those products. I'm just saying the first thing I'd ask is if someone tries to sell it to me, say this point to point, yes, no. If I'm not sure, well, that would scare you right there. Secondly, it says yes, well, where'd the dividends go? Okay, so that's why I say probably stay away from those products because you're giving the money to the insurance company that should be yours. Just no other way around that. On top of that, we'll just dive into this here as well. So just be careful of those products. So what I was interested in, I was born in 1970. I looked at Robert Shiller's from Yale, his Excel spreadsheets he has available for anyone to review. Just go to type in Robert Shiller, Yale, and you get all his free stuff. Shiller's a guy from the Cape, the cyclically adjusted PE ratios, the irrational exuberance book. So Shiller's a bigwig in the financial industry for his number crunching. I'm a big fan of his, as a matter of fact. And so he has these numbers out here for anyone to see. And what we're doing is we're taking the S&P 500 and we're going to reinvest dividends, and we're not going to reinvest dividends. It's that simple. Reinvesting, we're not doing taxes, just reinvesting dividends, not reinvesting dividends. And then we're going to see, after we adjust for inflation as well, what the numbers look like. So let's dive right into this. I think it's incredibly interesting. So in 1970 till the end of 2017, a dollar invested in the S&P 500 returned 10.55%. With dividends reinvested. A dollar invested in the S&P 500 without dividends returns 7.27. Well, that's not that big of a deal. Yes, it is. $1 invested in the S&P 500 with dividends was now worth $123, my friends. $1 invested in the S&P 500 without dividends is worth $29.04. That's $100 almost difference between dividends invested versus dividends not reinvested. Now that just shows you the fallacy of looking at your fees as a percentage as opposed to just dollar amount. I'm telling you, I was talking to this wonderful couple yesterday from California, and I said, you got to find out what your fees are. They have Schwab, and the guy Schwab's like, well, they're dancing around. 1% or 0.55% of your grandfather, blah, blah. They said, how much? Well, how much? Finally, like pulling teeth is $12,000. I was like, this is what financial advisors are trained on. They're trained on to say your fees as a percentage, not as an actual dollar amount. So if you're talking to a financial advisor, he says, I charge a regular fee about 1% of assets. And you say, okay, if I give you $500,000 to invest, how much is your fee? 1%. How much is that in dollars? Well, it's 1% of $500,000. How much is that in dollars? I want you to tell me. And I'm telling these guys dance around to that because they know if they were that confident in their fee, they would not be trained not to talk dollars. They'd talk dollars. They say, well, $5,000. Okay. And they say, is that including the investments that are in there as well? Well, I use low cost funds. Like what? What do you use? Now you know. So if you're $5,000 for 1% a year management, and let's say 50 basis points for the investments they use, that's $7,500 total in fees. So that's, but all that matters isn't that you're paying the guy 1%, is that $7,500 is coming from your back pocket or your purse to pay the guy. So when they start going down that road of just 1%, how much is that in dollars? Because here in dollars, $123 because you reinvested dividends versus $29 because you didn't is a big flipping deal. That's a big deal. Now, if you adjust it for inflation, we double our rate of return net of inflation simply by reinvesting dividends. And that would give us $1 after inflation, because inflation back in the 70s was quite bad. So $1 grew to $18.85, significant destruction of purchasing power due to inflation, but still, it grew to $18.85 when inflation is factored in, but only $4.44 when inflation is factored in for not reinvesting. Again, basically a 4 to 1 range, so $4 more for every $1 of the non-reinvesting dividends, and that's a 400% improvement in your portfolio because you reinvested dividends. It's that simple. So if you don't have dividends reinvesting, you're leaving big bucks on the table. All right, so let's go to 1980, and we'll just go down the list here. So 1980 with dividends reinvested, $1 grew to $70.01 because we had an 11.83% rate of return. 8.81% rate of return without dividends, which meant the dollar grew to $24.77. Factor in inflation, we have 8.45 as our rate of return when you factor inflation with dividends reinvested. 5.52 is our rate of return annual from 1980 till end of 2017 without dividends reinvested. $1 in this case grew to $21.81 with inflation, and it grew to 7.71 when inflation is adjusted in this scenario. So basically a 3 to 1 roughly. So in this case, from 1980 until the end of 2017, every dollar you invested with dividends reinvested gave you $3 more per dollar invested than not reinvesting. The interesting thing is, you'll see, this is where inflation really sticks out. So from 1970, a dollar grew to $123, but after inflation is only $18.85. From 1980, a dollar grew to $70, but after inflation it actually bought more than it did from 1970. See what I'm saying? So after 1980 till the end of 2017, inflation adjusted, we had $21.81 in purchasing money for every dollar invested. From 1970, 10 years earlier, 10 more years to grow, we only had $18.85 in actual purchasing power. Why? Because the inflation of the 70s, the whip inflation now of our Nixon time, which he did not do because he was a Keynesian, even though he was Republican, the inflation just destroyed wealth. There's no getting around that. So from 1980 till today, thankfully that was been nipped in the bud to some degree, but you can never get away from inflation. It's still there. All right, so from 1990, you see same things happen here. 9.82 to 7.49, dividends to non-dividends. A dollar without inflation grew to $13.77 or to $7.57 without dividends. A factor in inflation, and again, now it's basically a 2 to 1 difference here. A dollar grew to $7.04 with inflation and dividends to $3.87 with inflation and no dividends. So let's just go back. Basically a 4 to 1, roughly 4 to 1, 3 to 1, 2 to 1. It's pretty interesting, huh? How it's as the years go further and less compounding, it doesn't give you the same oomph of dividend reinvesting. But for long-term investors who want more compounding, for more long-term money growth, you need the dividends to be reinvested for sure. It just goes to show you, the longer the term you can allow your compounding to work, just the more money you'll make for it. Just no getting around that. All right, so here's 2000, the start of the market chaos, if you will. $1 or the annual return of a dividend reinvested in the S&P 500 from 2000 to the end of 2017 was 5.37 with dividends reinvested, or 3.32 without dividends reinvested. And then the $1 just barely doubled, a little bit more than doubled with dividends reinvested, and it did not double without dividends, if that makes sense. So 2.25 to 1.82 dividends reinvested versus not dividends reinvested. Factoring inflation, $1 grew to $1.75 after inflation with the dividends reinvested. $1 grew to $1.24 after inflation without the dividends reinvested. So when you factor in inflation, you're looking at 0.24. You made a quarter. For every dollar you invested, you made less than 1 quarter back after 18 years. A couple things that show you there. The incredible bad luck of bad timing, retiring into a down market, really, I mean, that's 18 years, and you just didn't do well. After inflation, you made 3.16. Yeah, it's interesting, same number here. After inflation, or 2.74 in terms of your overall rate of return. This is before taxes too, by the way. And here you only made 24 cents for every dollar invested 18 years previously. Here, at least, you made 75 cents, so 3/4 to every $1. You made 3/4 for every $1 you invested 18 years ago. Here, you didn't even make a full quarter. From 2010 till the end of last year, because this is a growth market, a bull market, the S&P 500 returned 13.89, which meant a dollar grew to 2.83 at the end of those 8 years. Yeah. Without dividends, the return was 11.53, and a dollar grew to 2.39. So as again, you can see the difference when in down market, we actually have more money in our account in 2010 than we had from starting out 10 years before, because we avoided the down markets of 2000, 2001, 2002, and 2008. Even though we had less time for the compounding nature to kick in, because we got hit with no down markets, we actually have more money in our accounts, even though it was less time. And that's because of the down market. Here's the inflation. So here's the inflation. I'm not going to call it a bear market, but the inflation destroyer of wealth. In 1980, we have more money in our accounts net of inflation, even though we had less time for it to grow, even though we had less money in our account gross of inflation. But net of inflation, we have more money in our account in 1980 than we did from 1970, because inflation is a destroyer of wealth. The other destroyer of wealth is a down market. And again, from 2010 till today, we got more money in our accounts, net of inflation or gross of inflation, it doesn't matter, than we did 10 years previously, even though we had longer compounding term. Two destroyers of wealth: bear markets and inflation. That's what you're contending with for a few soon-to-be retirees. So at the end of 2010, $1 annual return is 12.02. That's a net of inflation, and $1 grew to $2.48. Again, net of inflation. $1 grew to $2.10 net of inflation, with dividends not being reinvested. So the story speaks for itself. Every single time, without dividends reinvested, you left a lot of money on the table. That's basically what, 40 cents, 2 quarters, $3 or so, about $3.50. $14 and $14 again. I mean, net of inflation, you are leaving a lot of money on the table by not reinvesting dividends. That's all there is to it. Some would say, well, Josh, the fixed index annuity, if we had it from 2010, yeah, it didn't show off so well because the markets were up, but it showed off better from 2000 to 2018. Well, it might have. I'm going to challenge that to some degree for sure. Because did the fixed index annuity give you 5.37 gross of inflation? No, it did not. So even though we got hammered a little bit, the facts are, if we would have held on, I get a big thing, if we would have done just fine in the S&P 500, not relative to historical norms, but we would have done okay relative to the fixed index annuity. Those 10-year time frame from 2000 till 2010, the fixed index annuity would have done better. No other way around that, because we avoided those losses. What else would have done better? CDs. I mean, that's CDs, banks, bonds. I mean, government bonds would have done better. I don't know about corporate bonds. I have to look at that. And I'm not sure about treasury inflated bonds as well. But again, if the bear market is what we're trying to protect ourselves again, a fixed index annuity isn't the only thing out there. It's not. Bonds would be the protection against the bear market, or certificates of deposit. Or the next one I'll do is I'm going to do a 50-50 mix going back to 2000, using the Vanguard total stock market half, and then I'll use half like the Vanguard Treasury inflation protected bond fund, or the Ginnie Mae. I'll use one of those two to just get a gauge of what that would have done relative to a fixed index annuity. Secondly, we also have to be on the lookout for inflation. And so if we're not reinvesting the dividends, that's just going to the insurance company, essentially as a hidden fee, we're immediately handcuffing ourselves. I mean, the proof is right here. I mean, that's a significant handcuff. Look at these numbers. If you're not reinvesting dividends and inflation kicks in, you are leaving serious money on the table. I don't care what time frame it is, 10 years, up markets, down markets, it doesn't matter. Without reinvesting dividends, you are hamstrunging yourself to beat the evils of inflation. There's no getting around that. And then on top of that, you still got to factor, you're capping yourself you're capping yourself in the Pacific Life case, which I talked about yesterday, at 5% up. So you're saying not only am I not getting dividends, but I'm capping my upside to 5% a year. You know, you take that and factor in with inflation, it's going to be tough. And we'll show you that again. I think that'd be kind of interesting to see what that looked like. But if you factor in it with inflation from 2000 to 2017 with a 5% cap, because that was the best time the fixed index annuity looked good from 2000, because it avoided the down markets of 2000, like I said, the 4 years of the first part of the 2000. So if you factored in inflation and capped that at 5%, which is what the Pac Life Index Annuity does, and took out dividends, and we did that compared to a 50-50 Vanguard Total Stock Market Index, and again, just a Ginnie Mae, it'll be interesting to see the difference. I have a sneaky suspicion it's going to look pretty good in one direction. But I'll do that next. We'll see. So don't forget to subscribe. As always, comments, questions. If this helps you and you want to donate, you see my little PayPal link on the top of where it says Heritage Wealth Planning. It says Building Sustainable Wealth. You see the link for Amazon, which you can go buy my books. I think you see the link for Facebook, LinkedIn, and then PayPal. By all means, you want to donate away. And then subscribe and comments. We'll see you next time. Thanks, guys.